In this video, you're going to learn the 10 elements of presenting equity research that wins the CFA Research Challenge. This is Andrew Stotz of Stotz Investment Research. Let's get started. I was a two-term president of CFA Society Thailand, and I've judged many presentations over the year, all the way back to 2009 when we did our first competition for the CFA Institute Research Challenge in Thailand. I've also been a regional judge and have learned so much myself by being involved. So I've listened to hundreds of presentations, and I've come down to 10 elements that can help you win. So let's get into it. The first element is to focus on your conclusions. Kick off with a definitive recommendation, target price, upside, downside, and a forecast. Describe the main points and the catalysts that could drive future value and price. And explain your method of valuing the company. Next, title each section with a powerful conclusion that grabs the listener's attention. Conclusion? Wait a minute. That's right. Start with conclusions. Then provide evidence to support your conclusion and then restate it. Now, let's listen to the University of Sydney present the 2021 CFA Institute Research Challenge Global Finals. They were representing Asia. Here we can listen to their 22 seconds launch.
Insurance Australia Group is a leader amongst Australia and New Zealand's general insurers, historically generating the highest profitability ratios. However, IAG is facing a perfect storm of headwinds, which will prompt it to lose its shine, warranting a sell recommendation with a 12-month target of $4.32, a 12% discount to the 1-month VWAP.
So, not bad, but I would say the graphic there doesn't give you much. Let's go on to the next one. Appalachian State University, representing the U.S. or the North America region.
Hello, my name is Sean, and I am joined by Obi, Olivia, Sam, and Zach from Appalachian State University. We are presenting a sell recommendation for the Albemarle Corporation with a target price of $95.50, representing a 37% downside from Friday's closing price. We believe ALB is a sell because its business mix and contract structure will prevent superior profitability. Also, its balance sheet strategy to fund capacity conflicts with maximizing shareholder wealth. And finally, Albemarle is not the environmentally friendly, pure lithium play that investors think it is.
So this is a good example of adding in the main points that you want to get across. I think this is a better kickoff. Let's look at University of Waterloo, again, 2021 CFA Institute Research Challenge Global Finals. They took 27 seconds.
Grocery retail in Canada is widely regarded as stable and mature. Empire Company Limited, the second largest player in this space, has new management that continues to turn around the business, unlocking value for investors who are hungry for return. Following the recent launch of Empire's second multi-year initiative, we are pitching a buy recommendation on the stock with a target price of $47 per share.
So not bad. I don't know about what does second multi-year initiative mean. That's a little bit complex for someone that doesn't know this company or anything that's going on. All right, and here is the winning team, BI Norwegian Business School. Let's hear their kickoff.
I'm from BI Norwegian Business School. We are here to present our buy recommendation for Vestas with a target price of 1,480 Danish kroner and a 23% upside. We believe the market has underappreciated the following three key catalysts: Vestas' technological moat, which unlocks a higher pricing potential, its offshore expansion, maximizing shareholder returns, and its unique position to capitalize on the renewable transition.
Again, the desire here is to introduce the three main points as well as the valuation. So now, after listening to so many, I decided that I would create what I'll call my perfect 30-second pitch. Let's see if I can do it in 30 seconds. We are initiating coverage on consumer retailer made up with a buy recommendation. Our DCF valuation gives a target price of $147 US, which is a 27% upside. There are three factors that drive this recommendation. First of all, the stock is cheap relative to peers. Second, it's growing faster than analysts' forecasts. And number three, it's unknown, but institutions are starting to build a stake. My name is Andrew from Tulip University, and next, Sonchai will introduce the company and why now is the time to act to capture that 27% upside. How did I do? I introduced the company's name, the recommendation, the valuation method, the target price and upside, the three main points, and I tried to put a little urgency in there. Let me tell you a story about my first job as an analyst. It was back in 1993, and basically I thought that the job of an analyst was to project your recommendation far and wide. I didn't realize that actually it's taking a lot of information down to something really, really simple and clear. Now, we presented our best ideas to our salesmen and women each morning in our offices. They had their notebooks and they would sit there and write their notes. Now, one day, my boss was in Hong Kong and he was watching over the shoulders of the salespeople that were in Hong Kong, listening in to the teleconference that they always listened into. Now, he watched what they wrote while I spoke. And what did they see? They see that I wrote down, he saw that they wrote down three words: cheap, growing, and unknown. He, in fact, saw them writing down the three words that I was presenting in detail: cheap, growing, and unknown. Now, how many people did I reach that day? As a young analyst, I thought I reached 4 salespeople that were in Hong Kong. However, what I didn't realize is that if I made my message clear, they would communicate each to their clients. Imagine, one of them called 10 clients, another 20, another 15, and another 30. That means I didn't reach 4 salespeople, I reached 75 potential clients. I learned the power of multiplying my message. Now, let's go back in time. When you see this slide, you know I'm going back in time. Can you recall the 3 words that I just told you about my investment? Got them? Number 1, number 2, number 3. Let's review. Cheap, I said relative to peers. Growing, I said faster than analyst forecasts. And unknown, I said invest now as institutions are coming in. So this was a demonstration which I just did, which teaches you to have a simple message: cheap, growing, unknown. Now, don't worry about writing all this stuff down. The link below has the cheat sheet that you can see in that picture right there, and you can get all of this plus a bonus that you're going to get at the end of this video, and that is the 13 questions you must answer. Now, number 2 is make it enjoyable and memorable. Present as if you're competing for your listeners' attention and retention, because you are. Most people are asleep or they're thinking about something else. You want to take your listeners on a journey of discovery. Tell them a story and develop the characters in the story. Not one of the finalists developed a character in the story. Make your presentations pleasant with concise language, clear fonts, and an attractive layout. And then create powerful visuals that communicate one message each. And of course, keep up your energy until the end of the Q&A. In fact, when you're doing it live or even on camera, until you are off stage. Then rehearse, improve, and then repeat until the day of the presentation. Let me tell you another story. Let's go back in time when I was a young analyst. There I was pontificating about something, and I met this guy, Dr. Somchai of S&C Former Public Company Limited. This happened to be in Thailand. I looked at his business, which had many parts to it, and you can see this part, B2EA part. That is a division of the company. Now, what I saw that initially attracted me to this company was the inventory conversion period going down. Now, I've simplified this a little bit just to illustrate, but imagine if you saw an inventory conversion period for a factory go from 80 to 10. That is a very rare thing, and here you can see it in graphics form. So, I went to visit the factory and talk with Dr. Somchai and managers in the factory. What I found out was that they were completely focused on the idea of reducing inventory in the factory. Every team had that as a responsibility, and they were focused. And as a result, what happened was even other parts, they improved other parts, but that was kind of the biggest improvement. but this is roughly what I saw. I saw a cash conversion cycle that actually went negative. And here you can see that that took a long time for them to get there. Now, why is it important or why is it valuable for a company to have a cash conversion cycle that's negative? Well, I've never even seen it in my whole life as an analyst for a factory. But here's why. Because look at the table below. It's the free cash flow table. First, we start with NOPAT, and then we add depreciation. So I like to call that cash NOPAT. Let's imagine that we grow it by 7% each year. Then we have a change in net working capital, and that's where the cash conversion cycle comes in. The investment needed for working capital is getting smaller and smaller. So the cash NOPAT minus that net working capital gets reduced less. You can see in the first year it was 250 in cash NOPAT, and that had to be reduced by 100 to get down to 150. And now if you see all the way to year 8, you have 401 minus 5, only $5 million. And that leaves you with 397, almost all of your cash NOPAT after net working capital. Now that's not the only calculation that matters. The next one is that CapEx. Now here again, I've just, for simplicity's sake, I've kept CapEx growth at 7%, just like NOPAT. And what you can see is that the free cash flow of the firm starts to really rise dramatically. And here we can see it where the company went from a negative free cash flow to the firm to a massively positive one. And why is this important? Because free cash flow to the firm rising to this extent can increase the value of any company because we discount those future values. Which brings me back to the story of Dr. Somchai and our discussion of his strategy. He taught me many things about what he was doing, but the main thing he was doing was putting the responsibility down to the factory floor for inventory by every division. And he encouraged them to look for new ways to do it. An impressive man and an impressive lesson for me as a young analyst. Now let's go back in time. I just told you a story, a narrative. Somchai, SNC, free cash flow. This is the element of telling a story that really gets something across. You're never going to forget stories, but you'll often forget the other stuff. Remember, the second thing that I already showed you was keep your message simple. Remember, mine was cheap, growing, and unknown. Now, also, make your presentation pleasant. Even the way you appear on video or on stage can make a big difference. So, let's look at this university, Appalachian University. They had a great look on their video. Let's just focus on their pictures. They're perfectly aligned and they're centered. I think it looks great. Now let's look at the other one from Australia, and you can see that the guy down, 3 down, has got something red behind him, and then the guy below and the fourth guy is sitting far back, and in fact it just doesn't feel uniform. In fact, the lighting is different. And here you can see the lighting is a little bit better. So now, it's not just the participants, it's also the judges. What can you see here? Judges don't all look directly into the camera. There's inconsistent backgrounds, right? The bottom 2 judges are looking to the side, and that part really can be distraction. So now, let's look at BI Norwegian Business School and how they did a good job making their message clear. Let's see.
Potential from Vestas is offshore expansion. Offshore is set to become a $1 trillion industry by 2040, and Vestas has already made its move. It recently launched the world's largest wind turbine of 15 megawatts, enough to power 20,000 homes. The turbine is designed with standardized onshore components, and after the recent acquisition of MHI Vestas.
So I like this one because you can see he was speaking the titles, $1 trillion industry, and also he said recently launched the world's largest wind turbine. He was going from left to right and he was speaking it. I could follow that well. That not all of the teams did it that way. Now, think of your listener and the conditions under which they'll be listening. Here's an example. Here's a judging team in 1 year. That was me with a big beard. But these guys are really trying to pay attention and very serious about it. But there's always distractions, so you have to make it clear. Now, number 3, conduct a comprehensive company and industry analysis. Now, you want to assume the audience knows nothing about the company and the industry. You want to show that you have considered various outcomes in addition to your central argument. And you want to anticipate the top 10 questions and answer them in your presentation. Also, you want to apply frameworks to analyze the local, regional, and global industry trends and describe industry barriers to entry and the company's competitive advantages. Let's give an example of a company and how to introduce it. I think a lot of the teams didn't introduce their companies in a way that the judges could say, oh, wow, I understand that company. So let me give you an example. Let's talk about Thailand's leading instant noodle producer. 57% of their revenues come from instant noodles. And basically that they have the largest instant noodle market share at greater than 50% in the Thai market. And they produce 7 million tons of daily production. And they market under the famous brand called Mama. And you can see my arrows pointed at the Thai language branding. And what's the next thing? Bakery. 30% of their revenue comes from breads and things like that. And it's sliced bread, it's buns, it's cakes, it's sandwiches where they add things into the bread and other snacks. They sell it to hypermarkets, retail shops, and fast food chains. And they're distributing under the Farmhouse brand, which again is in Thai on that bag. Now they also sell biscuits, fruit juice, and packaging, but these are pretty small. You can see 4% for biscuits, 4% for fruit juice, and then packaging for food and paper cups. This describes their business. So again, another demonstration. Let's go back in time. What am I asking you to do? Help your listeners understand that company. Remember, they know nothing about it. Remember, I've also told you about telling a story of a character. In that case, I told the story of Somchai SNC and the free cash flow. And then finally, make your message simple. Remember, mine was cheap, growing, and unknown. Now, let me introduce you to Michael Eugene Porter and his impact on business strategy and success. Chances are you've either read these books or you've learned about them. I have them right here in my shelves. And I'm going to summarize Porter's work on one page. Ready? Be unique to sustain superior performance. Number 2, differentiate or become a low-cost leader. Number 3, competitive advantage originates in your value chain and shows on your P&L. Number 4, competitive advantage is built through your management and coordination of the various unique activities you perform relative to peers. And number 5, the 5 forces model drives an industry, it explains an industry's profitability and a company's position in it. Now, Porter's core strategies to build competitive advantage were the cost leadership, let's say McDonald's, where you're trying to produce at lower cost or sell the same thing for less. Differentiation, you could say, was Starbucks, be perceived as different from your competitors. Now, this often requires large R&D and high quality. Now, Porter did have a third strategy he called the focus strategy, where you aim at a target market or a niche or a segment. This is where most small businesses compete. And then you decide whether to pursue a cost or differentiation strategy. I would argue that cost leadership and differentiation are really the true strategies, and that focus is just the direction that the management team decides to aim its cost or differentiation strategy towards. So use Porter 5 forces as one way of describing this business. So to build competitive advantage is to build a moat. That is a deep, wide ditch surrounding a castle, fort, or town, typically filled with water and intended as a defense against attack. Some of you have been to Chiang Mai, Thailand. The inner city is surrounded by a moat. Now, where does competitive advantage come from? This book is the best. I highly recommend it. It's called Understanding Michael Porter, and it's Joan Magretta. She knows Michael Porter very well, and this can summarize it all in a very short book. Now, let's recall the 5 forces. First, you have rivalry, which is the intensity of rivalry amongst existing competitors. Next, you have suppliers, bargaining power, customers, bargaining power, entrants and the threat of new entrants, and then the threat of substitutes. So let me ask you, where does success come from? In 1979, Michael Porter introduced his 5 forces model in the Harvard Business Review. Porter concludes that company success at creating value has mostly to do with 2 things: the industry it operates and the position it takes in that industry. If you can explain those things simply and clearly to your listener, you've made an excellent presentation. Now, this is an excellent framework to apply. So let's listen to one of the teams here describe the source of the company's competitive advantage.
Revenues. Vestas distinguishes itself by having the longest vertically integrated value chain, covering everything from turbine design to plant optimization.
So they're explaining the value chain. I don't like the way that it looks in the middle. I think they could have made it a little bit more clear with less busyness. But the point is, the value chain, the vertically integrated value chain, is where they're getting their competitive advantage. Now, the next thing is you want to anticipate the top 10 questions and answer them in your presentation. You must be able to put yourself into the mindset of the opposing side of your view. If you're recommending a buy, take a week and focus your effort on proving that the company is a sell. Now, I'm going to walk you through my process for creating and presenting a report or a presentation. This was a 140-page report that I presented to an audience of one of my business partners and clients phenomena. And basically, let's look at the process. We spent about 50 hours of time amongst myself and my team to create this presentation. On the first pitch, we got about 40 unique questions. We took 5 hours the next day to build the answers to the main questions into the presentation. On the second pitch, we got about 10 unique questions, and we took about 3 hours to build in those answers. And in the third pitch, we only got about 2 unique questions. The point is, find the main questions that you're being asked and then incorporate those into the presentation. I have seen perfect presentations where there's almost no questions from the judges. Now, the final presentation really had few questions, and this was the final presentation on their YouTube channel, which we did a live version of. Now, again, don't worry about writing all these down. In the link below, you can download this list, the cheat sheet of these 10, plus the 13 questions. Now, the next thing is to identify the key drivers of the company. You want to explain the drivers of the company's revenue, cost, margins, and investment. And you also want to focus on the key drivers and eliminate the less important things. Let's look at an example here about a company explaining the drivers of the company's revenues and such. I put in the bullets at the right just to help you to follow along about what they're saying. So let's talk about drivers.
We forecast costs to recover quickly after the pandemic, increasing gross margin to 16% in 2026. This is driven by cost reductions coming from supply chain automation, post-acquisition synergies, and input mix optimization. As a result, Vestas will improve its EBITDA margin, reaching 15% in 2026.
Now, this is an interesting thing to notice. Of course, what you can see is costs are the main thing that are driving that margin improvement. But look at what she said. She said, will improve. Will it? By 2026? How does she know? How is she so sure? I remember when I was young in the industry, I used to wonder, how is somebody so sure? Well, here's the reality. She made a mistake. You have to separate fact from opinion. If she had said, we expect improvement in EBITDA margin by 2026, then it would have been right. In fact, let's understand the CFA standards. Here, this is standard 5B, communication with clients and prospective clients. And the point number 4 is distinguish between fact and opinion in the presentation of investment analysis and recommendations. Let's look at an example that CFA provides right there on its site. Richard Stotz is a mining analyst for East Bank Securities. He has just finished his report on Boise Bay minerals. Included in his report is his own assessment of the geological extent of mineral reserves likely to be found on the company's land. Stotz completed this calculation on the basis of the core samples from the company's latest drilling. According to Stotz' calculation, the company has more than 500,000 ounces of gold on the property. Stotz concludes his research report as follows. Based on the fact that the company has 500,000 ounces of gold to be mined, I recommend a strong buy. So what was his mistake? Here we can see. If Stotz issues the report as written, he will violate standard 5B. His calculation of the total gold reserves for the property based on the company's recent sample drilling is a quantitative opinion, not a fact. Opinion must be distinguished from fact in research reports. So there's a little lesson for you. Now, Number 5, explain your vision of the company's future. You want to apply your knowledge of the company's past to make well-informed predictions. And now you learn those predictions are your opinions, so separate fact from opinion. Clarify what you expect will change in the company, the industry, and the macro landscape. Help your listeners separate facts about the company from your opinion on it. Now, apply your knowledge of the company's past to make well-informed predictions. Let's look at this example.
Onshore, where service accounts for 40% of Vestas' operating profit, offshore accounts for close to 60%. Vestas is the only player with unparalleled service and a global service infrastructure, which can therefore exploit this. With these advantages, Vestas is well positioned for a 24% offshore CAGR between 2020 and 2026.
So here you can see that he's building the case supporting his prediction. Now, I want to tell you a story. This story really kind of is a bit shocking, and I call it confuse and lose. I was once a judge in a case competition. It wasn't CFA, it was something else. The team was presenting a new device that they had developed to detect cervical cancer. Now, they did such a poor job of explaining it that the judge next to me whispered to me that she didn't understand what they were talking about. The interesting thing about that was this. She was a medical doctor. I wasn't even a medical doctor, but I was kind of understanding, but she didn't catch it. When you confuse, you lose. And when you confuse, it's very hard to get a judge back on your side. Now, the next thing is to present evidence to support your arguments. So what do I mean by that? Well, support your conclusion with evidence so that the listener finds it credible. You're not going to convince people like me without evidence. You want to represent the interests of the listener by being critical, objective, and independent. That's what the judge is looking for. They're trying to be critical themselves. They need you to help. How do you do it? You follow a simple format that I use. I teach another course about how to give a great presentation, but let's just look at some part of that. First, we start with P. P is the point, your main points to support your conclusion. What does it mean by what's your point? The stock is cheap, expect growth to explode, price should double, economy is going to bounce back. The next thing is, what is the E? Evidence. You've got to appeal to the logical left-brain people like myself. So, what's your point? The stock is cheap. What's your evidence? It's trading on 10 times PE versus 20 times for the industry average. Expect growth to explode. What's the evidence? Newest contract will add $100 million of profit. What's your point? Price should double. What's your evidence? If it re-rates to only 20% of industry average, it's going to double. Economy is going to bounce back. That's the point. And the evidence is it has bounced back after each of the past crashes. Now, let's talk about a narrative. A narrative is not the way we do research. We do research by starting by being independent and objective and trying to figure out the reality. Now, a narrative is a way of presenting or understanding a situation or series of events that reflects and promotes a particular point of view or a set of values. In the US, we have conservative and we have liberal, and that's often the narrative that they go into anything. And what we try to do as an analyst is to strip away that narrative. To give an example of a narrative, you could say the rise of the Tea Party and the weakness of the Obama economy have fueled a Republican narrative about big government as a threat to liberty. I took this from Merriam-Webster's dictionary, and this gives you some example of narrative or what we also call framing. Now, this could be a violation of CFA standards. What standard? Standard 1B, independence and objectivity. Here is the standard, and what does it say? Says that we have to use reasonable care and judgment to achieve and maintain independence and objectivity. Step back and be independent and objective. In fact, you can think of today as your Independence Day. Now, top analysts are independent and objective. Remember, you do not represent the company. Do not go up and speak as a mouthpiece of the company. Number 7, describe the catalyst driving future value and price. Differentiate between value and price, and then you forecast both. Describe how your valuation assumptions and methods differ from the markets. Explain any divergence between price and value and why that might change. Remember, You could value a company at 100 and the price could be 500 in the market. Price and value are two different things. Now, we like to think that they're going to converge at times. They do sometimes, and they don't sometimes, but that's your job as an analyst. Let's just look briefly at the valuation pages of these four teams. First of all, you can see the first one up in the upper left starts with a picture. I don't really like that because it's kind of a waste. If you see, I use chapter dividers, but my chapter dividers have something that they're saying, each of the 10 elements. This one just says valuation and investment risk. They're wasting space on that. Now, you can see, then you open up that top left, and you can see they do what's called nowadays called a football field type of analysis, breaking down different methodologies. And that's the same thing that's happening over on the right teams. And then you can see that that team up at the left has now reached its final, so it only really had two slides. And the other ones continue on, but then the one to the top right and the one to the bottom left are both at their final slide. The one at the top right is doing a Monte Carlo simulation. Now, we can see the one at the bottom right is continuing on until it hits its final one. Why is this interesting? If you're in a competition where there is a limit to the number of pages that you can submit in your presentation, you're kind of screwed, right? You gotta put in, you can only do so many pages, and that forces people to bring a lot onto each page. But as of this speaking, from my understanding, the research challenge does not limit the number of pages, it limits the time. And therefore, you can try to put less on each page. And the result is that this presentation done by the Philippines, let me just see what that number is. It's got 50 slides, and that's much less than the other ones. And that's because they're spreading it out. Now, let's look at the investment thesis translated into financials.
Ara will now show you how our investment thesis is incorporated in the financial projections.
We project Vestas' revenues to grow at a CAGR of 11% over the next 6 years. Growth will be driven by an increase in deliveries and gigawatts under service. This is a result of increased electrification, green investments, Vestas' tech-enabled services, and its offshore expansion. We also expect Vestas to maintain stable prices, which will further support the revenue growth. We forecast costs to recover quickly after the pandemic, increasing gross margin to 16% in 2026. This is driven by cost reductions coming from supply chain automation, post-acquisition synergies, and input mix optimization. As a result, Vestas will improve its EBITDA margin, reaching 15% in 2026. We expect Vestas to retain its margin leadership due to industry-leading technology. Historically, Vestas has obtained superior profitability compared to peers. We predict this to continue and result in favorable shareholder returns, with EPS growing at 20% CAGR between 2020 and 2026. We therefore expect Vestas to increase dividend payout, reaching 4.8 euros in 2026. We project CapEx to rise as the company expands into offshore. However, this is offset by an increase in operating profitability. With an interest coverage ratio 3.6 times higher than peers, Vestas has solid debt capacity that can readily support its offshore journey.
Now, this was an excellent discussion up to that point of translating their investment thesis into the financials. Let's look at their discussion of valuation, which I also thought was excellent.
We issue a buy recommendation for Vestas with a target price based on a multi-stage DCF analysis. This model befits Vestas' innovative company profile, allowing us to account for both its aggressive and its stable future growth phase. With cost of capital estimated at 7.1% and terminal growth rate of 3%, we arrive at a target price of 1,480 Danish kroners, which represents a 23% upside. On a positive note, we do see a potential upside for conservative terminal growth based on the anticipated renewable boom and Vestas' favorable market position. This will result in further share price appreciation far beyond our target price, as seen in the sensitivity analysis.
So this was a good presentation because it's very simple. You can see the cost of debt, the cost of equity, the WACC, the terminal growth, and a sensitivity, and she steps through it. Now she hands it over to the next guy in their team to do a relative value discussion, and I thought this was also very good.
Now, to supplement our DCF, we conducted a relative valuation where we compared Vestas to 4 different peer groups: non-Chinese and Chinese wind manufacturers, solar manufacturers, and other green tech companies. We apply a small premium of 10% to Vestas' EV to EBITDA multiple to reflect Vestas' superior ESG and SDG positions compared to its peers, reaching a 2021 EV to EBITDA multiple of 24. This implies a price of 1,507 Danish kroner, a 26% upside, which confirms our buy recommendation. We expect a potential repricing of Vestas as we believe it should trade at multiples closer to broader green tech companies because of its superior technological leadership. We also conducted a bull and bear case analysis. In our bull case, we determined a price of 1,840 Danish kroner, a 53% upside in which the company fully realizes all synergies between their onshore and offshore segments. Our bear case indicates an 11% drop from its current price, but we believe this is highly unlikely. We also tested our key metrics with a Monte Carlo simulation. We varied WACC, terminal growth rate, megawatts delivered, onshore and offshore selling price, and cost of goods sold. 65% of the scenarios support our buy recommendation, yielding a share price more than 10% above the current price.
65%. This guy brings a lot of energy. It's a little bit over the top if you listen to it over and over, but hey, when you're doing your presentation, it's probably better to have that energy. One last thing I'd say is that in case competitions like CFA Research Challenge, they like to use the Monte Carlo simulation. I've never used that in my experience in work, and I've never seen a report of a credible analyst use it, but it's a tool that has seemed to have become popular. But just because you go through 1,000 simulations doesn't mean that you've got the right forecast. Now, number 8, explore alternative outcomes. You want to consider various scenarios, their likelihood and impact on your conclusions. And you want to clearly explain what could go wrong with your conclusions. Now here, I just want to do a brief look at the risks page of each presentation. The one on the right's just 1 page. The one on the upper left, all the other ones are 2 pages, and then 3 pages, they stop. And then again, the Philippines one goes on because they're trying to put less on the page. Let's look at an example that clearly explains what could go wrong with the conclusion.
We have identified 2 material risks to our sell recommendation. Firstly, yield-seeking investors may continue to find CBA attractive in this low interest rate environment. But there are signs of weakness in dividend sustainability with CBA's high payout ratio, and find that even a 50-cent cut to dividends will reduce intrinsic
1 minute remaining
by $8.13.
Don't be disturbed when people call in and say, time's almost up. Now, what does risk mean? Let's look at this one.
We identified post-acquisition integration and innovation risk as the 2 greatest risks. Post-acquisition risk can be mitigated by pre-acquisition insight and unified production. And innovation risk can be mitigated through high R&D spending and product flexibility. The other risks were either low probability or low impact.
Now, this is not a bad presentation on risk. I mean, it's simple, but be careful of minimizing risks, right? And avoid appearing as if you are the company management explaining how you're going to respond to this risk, how you're going to reduce it. Here, it starts to sound that way. You want to basically say, yeah, the company has some plans to reduce it, but don't minimize the fact that it is a serious risk. Otherwise, the audience is going to say, so you don't even understand the risk, or you don't even believe that any of these risks could happen, then they're not risks. So remember, it's a balance, but readers respect those who think objectively. Don't just say, we're confident, we can overcome this, the company can do this. You've got to be objective. Now, next thing is use Q&A to convert skeptics into supporters. This is number 9. Think of the audience questions as coming from honest, direct speaking friends. They want to understand it. Questions are your best opportunity to convert your skeptical listeners into fans. I mean, think about it. Why is a judge volunteering their time, valuable time, to do a judging? Because they care about young people developing. So even though they're tough, they're there because they care. So don't get confused and think that they're against you. Also, don't let poorly worded questions become your problem. Ask for rephrasing. I've seen it happen many times where judges give bad questions. Just ask them, sorry, I didn't understand that. Could you simplify that question? Also, prepare additional slides to answer anticipated questions. Plan which team member will answer which type of questions. And directly address the person who asks you a question and clearly answer it. Well, Bob, to answer the question you've just asked, this is the way you do it. You go directly to the person who asked the question. Keep your answers short and minimize the tag-along. What I mean by tag-along is when one person answers the question and then another person says, oh, and another thing. And then another person says, oh, yes, and also. It's too much. Try to stay focused on one person answering the question and maybe allowing one other tag-along, but no more than that. Now, I participated in the SCG Bangkok Business Challenge at SASIN, and there's some good questions that I thought about to show you. One of the biggest startup competitions for undergrad and postgraduate students worldwide. It was founded in 2002 by SASIN School of Management, and in 2008 was open to teams from across the globe. Now, I've been a finalist judge for decades. Let's just look at some Q&A, which I was able to grab from those. So you want to be able to describe the market in detail.
And what level of market penetration do you think you can get by that year? Would you? Yeah. Okay, let me ask it another way. There is an opportunity, yes, for solar panels on top of buildings and houses in India. What is the size of that opportunity? What is that market size?
$15 billion, 40,000 megawatt is the target.
So clearly explain market penetration and market size. Now, these are startup companies, but I picked out questions that I think can help you with Research Challenge. Here is explain the detail about the revenue.
What is the percent of the new product in the last year of the revenue? The idea that you're going to get to $10 million in revenue by 2026, they don't match to me. Mm-hmm. Explain. When do you expect to start getting revenue if things work according to plan? Can you show us your chart about the revenue forecast of the number of customers you're going to get, this year, next year, and kind of a little bit more breakdown of where that's coming from? The question I have is that you go from, let's say, 3 million roughly in revenue in 2021 up to about 30 million. It's not bad, but I would think that if the demand is so strong, wouldn't it be a much higher number?
So now let's look at the next thing about CapEx.
1.6 million.
So how much money do you need then to go from that point when you've got approval to actually scale it up to sell the millions of units that you're talking about selling? Okay, so, and really what we're talking about is you're still in the proof of concept stage. But once you do that, let's just say that you do that and you're successful, then the business will take off. Will you need more financing at that time, or will that 500,000 and the money that you have be enough?
So, also, here's a common forecasting mistake that you want to avoid. Too much cash.
The reason why I'm not going to invest in your company is because at the end of the 5th year, you're showing that you have $100 million in cash in your balance sheet. That's crazy. So take it from there.
Okay, so
But more importantly, you're claiming that you're going to have cash of $125 million in the 5th year. It's just, you've presented numbers that appear as a cash machine. I have to doubt. So tell me, where are these numbers wrong?
So that's the most common mistake, is putting too much cash. And you can do it by having too much profitability, too high profitability, and also not enough CapEx. Next, be able to explain the inputs to your valuation.
Let's say that you're worth roughly $10 million at that point in time. But you said that my 250 is going to get me 7.5% of the company. Let's just say you're worth 10 million. That means that my stake is worth $750,000, right? So I put in $250,000, and 5 years later, my stake's worth $750,000 according to my calculation. It's not a great return, particularly considering the high risk of this. So can you help me understand this better?
Sure.
I don't need to understand what the medium case is. I just want to know your valuation of the company is based upon the medium case, or it's obviously not based upon the worst case.
Yeah.
And avoid being overly optimistic.
So you're saying that the NPV of this company is $346 million?
In 10 years.
So tell me how you calculated that. What's your discount rate for that?
So those are some examples. Number 10, practice slowing down. Give your audience time to absorb the information. Never dump data on them. Be calm. It exudes conviction. Be confident. It engenders trust. Time for the bonus. 13 questions you've got to know the answer to. Number 1, they fall into 4 categories. First category is growth opportunities and constraints. Second is industry structure, market positioning, and strategy. The third is forecast, valuation, and catalyst. And the fourth is risk exposure and impact. Let's look at growth opportunities and constraints. Question number 1, what are the company's most significant growth opportunities? Number 2, what growth do you expect for the different regions or segments or divisions? Number 3, how well has management capitalized on past growth opportunities? Number 4, what are the company's constraints to growth? What about related to the industry structure, market positioning, and strategy? Well, number 5, what is the market position relative to competitors? Number 6, has the company's competitive position created an economic moat? Number 7, what are the barriers to entry for the industry? Now let's look at forecast, valuation, and catalyst. Number 8, what's driving the difference between your forecast and consensus? Number 9, what do you see that the market is missing? Number 10, what will cause the market to recognize what you see? Number 11, what assumptions underline your discounted cash flow value estimate? And number 12, what will close the gap between your estimate of value and price? And finally, one main question under risk exposure and impact, that's 13, what are the most significant risks and what impact would they have if they happen? So let's review. First, focus on your conclusion. Second, make it enjoyable and memorable. Third, conduct a comprehensive company and industry analysis. Fourth, identify key drivers of the company. Fifth, explain your vision of the company's future. Sixth, present evidence to support your arguments. 7, describe the catalyst driving future value and price. 8, explore alternative outcomes. 9, use Q&A to convert skeptics into your supporters. Number 10, practice slowing down. I wish that you find your passion in finance as I did, and that it transforms your life. Are you ready? So, take the challenge and find your passion in finance. Remember to download the 10 elements at the link below, and good luck on your next presentation.